Rachel Reeves stood up and promised a fairer tax system. What she actually delivered was the most aggressive squeeze on landlords and savers we've seen in over a decade. In this video, I'm going to break down in simple English the hidden tax rises no one's talking about, the ISA trap that under 65s are walking straight into, why landlords just got hammered again, how pensions are being quietly rewired and why. I'll also cover why the UK investor who doesn't use ISAs and SIPs is basically volunteering to get robbed, to get hammered. Part 1, the ISA shake-up no one was prepared for. Let's start with the thing 99% of people are already confused about. The cash ISA cap for under 65s. From April 2027, if you're under 65, your cash ISA contributions limit is being slashed to 12,000, down from the normal 20,000. Stocks and shares ISAs, still okay. Total ISA limit, still 20,000. But here's the thing. This is the UK government basically pushing millions of savers into the stock market, whether they want to or not. Now, I'm all for investing, but we should have the choice in my opinion. And if you think that sounds dramatic, here's the line from the budget itself. Under 65s must place anything over 12k into a stocks and shares ISA. Cash savers lose flexibility. Investors gain an advantage. The message from the government is clear. Stop saving, start investing. If you want to learn all about investing from someone who genuinely cares, hit subscribe so we can build wealth together. Part 2, a new first-time buyer ISA. The budget quietly confirmed something huge, but almost no one noticed it. There's going to be a replacement for the lifetime ISA, starting consultation in 2026, a simpler product for first-time buyers. Sounds good until you realise every time the government replaces a tax wrapper, early users get punished. Help to Buy, LISA, the new product, whatever they call it. If you're saving for your first home, the takeaway is simple. Keep using the LISA now, before they change the rules again. Part 3, investors just got taxed quietly. He's the stealthiest part of the entire budget and easily the most expensive for investors. Dividend tax, up 2 percentage points. Savings interest tax, up 2 percentage points, starting April 2026 for dividends, starting April 2027 for savings income. Let me make it clear. If you invest outside your ISA or pension, you're going to pay more every year on every pound. Dividends, property, savings interest, everything is being nudged up. This is why maximising your ISA and SIP is no longer optional. It's survival. Part 4, landlords. Another year, another tax hike. Landlords and property investors, more pain. From April 2027, property income tax rises to 22% basic, 42% higher, 47% additional. And that's not all. High value property surcharge, also known as the mansion tax, starting 2028. If you own a home worth over 2 million, you'll pay 2,500 per year, up to 7,500 per year for 5 million plus properties, and it increases every year with inflation. The government isn't even hiding anymore. They don't want you to make money from property. Simple as that. If you're a landlord in 2025, you probably need to rerun your numbers, recognise leverage, and seriously look at whether keeping property inside a company still makes sense. Because after this budget, the UK property market is now structurally less profitable than it was 10 years ago. As you can probably guess, I'm not a financial advisor, and this isn't me giving out financial advice. I'm not an expert, not even close, but I'm sick of seeing people I care about struggling financially, and my intention is to help as many people as possible with my experience. Part 5, pensions, the biggest shake-up in years. This is the part most people will ignore. This will cost them thousands. Salary sacrifice is getting capped. From April 2029, salary sacrifice, NIC advantages will be limited to 2,000 per year. For higher earners, this is huge. If you currently optimise your pension contributions through salary sacrifice, and in the UK, this is one of the best legal tax hacks we have at the minute, your advantage is disappearing. Defined contributions on pensions pulled into inheritance tax rules, starting 2027. Unspent defined contributions on pension pots will fall within inheritance tax. For 10 years, pensions were the ultimate inheritance tool. This budget ends that era. If you want your pension to be part of your estate planning, start planning now, not in 2027. Part 6, VCTs, EICs and UK IPOs. A little bright spot. Some good news. VCT income tax relief drops to 20%. Yes, that's a cut, but here's the interesting part. Company fundraising limits are being increased. more VCT and EIS deal flow, more early stage investment opportunities, and UK IPOs will enjoy SDRT relief for 3 years from late 2025. If you're an investor who likes early stage or high growth businesses, for the first time in a long time, the UK is trying to attract capital instead of pushing it away. Part 7, capital gains tax cracks down on business owners. 2 important changes. Employee ownership trusts drop from 100% tax relief to 50%. Non-resident loopholes closed. If you run a business and were planning an employee ownership trust exit, the maths just changed. Part 8, the bottom line, and it's a harsh one. Here's the truth nobody wants to say out loud. This budget doesn't reward savers. It doesn't reward landlords. It doesn't reward high earners. It does reward disciplined ISA investors, people who use pensions early, long-term index fund investors, those who understand tax wrappers, and UK investors who actually pay attention. Summary. It's very clear that if you are a saver, this budget is bad, and the UK government have made it very clear they want savers to start investing. So for me, we should all make the most of stocks and shares ISAs and SIPs. But here's the question I want you to answer in the comments. Which part of this latest UK budget hits you the hardest? ISAs, property or pensions? I want to know how you're planning to react, because your reaction might just shape your financial future over the next 10 years. And if you want a full breakdown of the smartest legal ways to avoid tax in the UK using ISAs and SIPs, see below for a recent video.